Welcome to Truth Behind History. Today we are diving into how US monetary policy set the stage for the Great Depression. Look around the America of the 1920s for a moment. Factories hum with new electricity. Assembly lines spit out cars faster than people can name the models. Radios whisper jazz into living rooms that, just a decade earlier, were lit by gas lamps. From 1919 to 1929, it feels like the country is on a moving sidewalk that only goes forward. Prosperity seems automatic. But here is the question that matters for us today. Was this boom a solid foundation, or a beautifully decorated stage set, waiting for someone to tug on the wrong curtain? Let's start with the post-World War I boom. Demobilization brought millions of soldiers home and, with them, pent-up demand. People who had postponed purchases during the war suddenly wanted cars, appliances, better clothes, and better housing. Industry answered with breathtaking speed. New management methods, nationwide advertising, and the spread of electricity raised productivity. When output rises and shelves fill, prices can look stable even as the engine is redlining. Growth was real, no doubt. The key is to notice how much of that growth depended on keeping the machine running at high speed, day after day, year after year. When the music is playing, everyone dances. The question is, who is holding the record player? Enter the Federal Reserve. Created in 1913, the Fed was a young institution in the 1920s, built in response to earlier banking panics. Its primary mission was modest compared to what we expect today: make the banking system more stable and provide elastic currency so that seasonal and regional demands for cash wouldn't topple banks. Think of it like a newly hired conductor stepping onto the podium of a very loud orchestra. The musicians are talented, the score is ambitious, but the conductor is still learning the hand signals. In this era, the Fed did not have sophisticated macroeconomic models or decades of crisis playbooks. Policymakers were experimenting, sometimes cautiously, sometimes confidently, with tools whose full effects they did not yet understand. Their goal was stability. Their influence, even when well-intentioned, would ripple far beyond the banking halls. Now, overlay the gold standard. Every dollar promised convertibility into a fixed amount of gold. That pledge acted like a tight corset around the money supply. If gold flowed out of the country, the corset tightened. If gold flowed in, there was a bit more room to breathe. The system imposed discipline, yes, but also rigidity. Imagine driving a car with perfectly aligned tires and an unbreakable steering lock. You will go straight beautifully until the road bends. Under gold convertibility, policymakers faced a trade-off: defend the gold promise at all costs, or allow more flexibility to cushion domestic strains. In the 1920s, the promise often won. Flexibility lost, and rigidity has a habit of turning small bumps into big jolts. Meanwhile, credit and speculation surged. Consumer finance went mainstream. Instead of saving for a radio or a refrigerator, families could buy today and pay in installments over months or years. Department stores, auto dealers, and finance companies turned tomorrow's income into today's sales. In the stock market, a different kind of leverage flourished. Borrowing to buy shares let investors control large positions with small amounts of cash. As more people borrowed to buy, prices climbed. As prices climbed, more people felt safe borrowing. It is a loop that feels virtuous while it rises. But leverage is a fair weather friend. When the weather changes, it demands to be paid first. Here is the nuance that often gets lost. None of these ingredients are villainous on their own. Industrial innovation can lift living standards. A central bank can steady a banking system. A gold promise can anchor expectations. Credit can smooth consumption. But combine rapid industrial expansion, a young and powerful monetary institution, rigid rules that limit course corrections, and a cultural embrace of easy credit, and you create a system that looks stable until small errors get amplified. The stage is set not by a single decision, but by the way these pieces interact. So ask yourself, if a single conductor can set the tempo, what happens when the tempo, even slightly, is off? If the money supply is tied to metal locked in vaults, what happens when the real economy wants to breathe? If households and investors learn to live on borrowed tomorrows, how sensitive does the system become to even a small pause today? These are not moral condemnations. They are mechanical questions, and the mechanics matter. Hold that mental picture: a country buzzing with new goods and new confidence, a central bank learning on the job, a monetary corset that rewards straight roads and punishes sharp turns, and a society discovering the thrill and the fragility of buying with promises. That is the US economy before 1929. The scenery is impressive. The lighting is perfect. The cast is ready. Now, the natural next question is simple: how, exactly, did policy choices during the 1920s add fuel to this momentum and subtly change the risks hiding underneath it? We will unpack that, step by step, on the next slide. We have set the stage, and now the spotlight shifts to the Federal Reserve's monetary expansion from 1921 to 1928, a period where the tempo quickened, the music grew louder, and the dance floor grew more crowded. Coming out of the brief, sharp recession of 1920 to 1921, the Federal Reserve took a decisive turn. It maintained historically low discount rates, the interest rates it charged banks to borrow from the Fed itself. Imagine telling every bank in America, money is cheap, come and get it. Banks did exactly that, expanding their own lending far beyond what would have been possible at higher rates. Credit became not just accessible, but irresistible. If you were a business owner, why not borrow to expand your factory? If you were an investor, why not borrow to buy more stock? And if you were a consumer, why not buy the latest gadget now instead of saving for it? Low rates didn't just grease the wheels of the economy, they encouraged everyone to spin them faster. But the Fed didn't stop there. Through large-scale open market operations, buying up government bonds in significant quantities, it injected more reserves into the banking system. Reserves are like fuel for banks. The more they have, the more they can lend. And in the 1920s, lending meant everything from financing new factories to funding speculative positions on Wall Street. Each purchase by the Fed sent a signal: the money supply can grow, credit can expand, and borrowing is safe. The official aim may have been stability, but the practical effect was to give the economy a steady push toward faster and riskier growth. This expansion of easy credit had a fascinating side effect: speculative leverage. When borrowing costs drop, the threshold for a good investment also drops. It's like lowering the bar in a high jump. Suddenly, a lot more people can clear it. Investors piled into the stock market, often on margin, meaning they put down a fraction of the cost and borrowed the rest. As stock prices climbed, the paper gains seemed to validate the behavior. But gains fueled by borrowed money create a precarious structure, one in which the foundation can shake if prices falter even slightly. The bigger danger was more subtle. These policies masked structural weaknesses in the economy. Agriculture, for instance, was already struggling in the wake of falling crop prices after the war. Certain industries were far less profitable than the headline suggested. Income distribution remained uneven, limiting the depth of real consumer demand. Yet the wave of cheap money kept these vulnerabilities hidden beneath a surface of prosperity. It's the difference between a building that looks pristine because it's solid, and one that looks pristine because someone just painted over the cracks. Here's the question we have to ask: was this prosperity truly earned, or was it propped up by conditions that couldn't last? Low rates and bond purchases can stimulate growth, but they can also nudge capital into riskier and riskier uses. They can make the economy more dependent on continued credit expansion, and they can encourage a belief that downturns are temporary, easily solved with another dose of cheap money. By the end of the 1920s, the Fed had helped create a landscape where credit flowed like a river in flood season, carving new channels through every part of the economy. It was a time when opportunity felt boundless, but also when the gap between appearance and reality was widening. On our next slide, we'll explore how the very signals that guided this boom, low interest rates and easy credit, distorted the way capital was invested, leading to projects and expansions that looked brilliant in the short term but were fundamentally unsustainable in the long run. Now we step into one of the most fascinating and dangerous parts of the story: interest rate manipulation and malinvestment. This is where the easy money of the 1920s starts to reveal its hidden cost. From an Austrian school perspective, interest rates are not just numbers on a chart, they are signals. They tell investors how much real savings are available to fund long-term projects. When rates are low because people are saving more, that's a genuine signal: resources are waiting to be used. But when rates are pushed artificially low by policy rather than savings, it's like giving a construction crew blueprints that say build a skyscraper when in reality, there's only enough steel for a 2-story building. The result? Projects that cannot be completed without either more intervention or a painful reckoning. Cheap credit in the 1920s distorted investment decisions across the board. Banks, flush with reserves from the Fed's earlier policies, extended loans into ventures that looked profitable in the short term but had shaky fundamentals. Risky loan expansion became the norm. If a speculative oil scheme or a flashy real estate development could show quick returns, money would flow to it, even if the long-term prospects were questionable. The focus shifted from will this investment be sound for decades, to will it make a quick profit before the music stops. This fueled overbuilding and asset inflation. Construction boomed, not just for practical needs, but for luxury goods and high-profile projects meant to dazzle. Office towers rose in cities already struggling to fill the space they had. Upscale apartment buildings and lavish entertainment venues multiplied. Prices in certain markets soared far beyond what everyday demand could sustain. It's the classic pattern: when capital is cheap, It often chases prestige and spectacle over necessity. Meanwhile, an equally important but less glamorous story was unfolding: the neglect of industrial reinvestment. Consumer credit boomed. People were buying cars, radios, and fashionable clothing at record rates, often on installment plans. But while money poured into consumer goods, reinvestment in the industries that built the country's productive backbone lagged. Machinery went unreplaced, infrastructure aged, and productivity gains slowed in some sectors. It was as if the economy was spending its savings on a lavish vacation rather than upgrading the tools it would need to keep working once the vacation ended. If we zoom out, what we see is a misallocation of resources, the very definition of malinvestment. The signals that guide investors were scrambled. Cheap money made almost any venture look promising on paper, so money flowed into the wrong places, in the wrong amounts, at the wrong time. That's why Austrian economists warn about artificially low interest rates. They don't just stimulate the economy, they change its shape, often in ways that make it more fragile. By the late 1920s, America was full of glittering signs of prosperity: skyscrapers, new subdivisions, stock tickers buzzing with trades. But beneath that shimmer was an economy increasingly dependent on borrowed money and overextended projects. The seeds of fragility had been planted, and all it would take was a change in the weather, or in policy, to expose them. And that change was about to come. On the next slide, we'll watch what happens when the Fed reverses course, raising rates and tightening credit, and how that sudden shift set off a chain reaction leading straight to the crash of 1929. Here's where the music stops. After years of easy credit, the Federal Reserve decided the tempo was too fast and abruptly slowed it down. This was the policy reversal and contraction between 1928 and 1930, the turning point that transformed a roaring economy into a crisis. In 1928, the Fed sharply raised interest rates. The goal was to curb speculation, especially in the stock market, where prices had been climbing like ivy on a wall. Higher rates made borrowing more expensive, which in theory should cool down speculative fever. But this wasn't just a gentle tap on the brakes, it was more like slamming the pedal. Liquidity tightened quickly, and the easy flow of money that had fueled the boom began to dry up. The effects rippled almost immediately. Credit contraction set in. Businesses that had relied on cheap loans found the cost of financing jump almost overnight. Investors who had borrowed heavily to buy stocks, often using margin accounts, were suddenly facing higher interest costs and stricter lending conditions. Default started to rise, not just among reckless speculators, but also among otherwise solid enterprises caught in the squeeze. Then came October 1929. The crash wasn't just about prices falling, it was about what those falling prices revealed. For years, the market's apparent strength had hidden the fragility of its foundation. When prices began to drop, margin calls hit investors like a tidal wave. People were forced to sell not because they wanted to, but because they had to. Selling begat more selling, driving prices down further and faster. In a matter of days, fortunes evaporated and confidence shattered. But the real danger wasn't limited to the trading floor. The stock market collapse triggered what we call banking contagion. Banks, many of which had direct exposure to the market or to heavily indebted clients, saw their balance sheets crumble. Fear spread quickly. People rushed to withdraw deposits, worried their bank might be next to fail. As withdrawals mounted, even healthy banks began to falter. This wasn't just a financial setback, it was the start of a full-blown panic. The tragedy here is that once confidence is lost, it's nearly impossible to restore it instantly. The tightening of credit, the spike in defaults, the collapse of market values, and the wave of bank instability all reinforced each other. What had been a single policy shift, raising interest rates, cascaded into an economic unraveling. Looking back, it's a stark reminder that changing the conditions of credit in a highly leveraged system is like altering the oxygen level in a sealed room. Too little, too fast, and the system doesn't just slow down, it suffocates. In our next slide, we'll see how, after the crash, the Fed faced a critical decision: step in as the lender of last resort to stop the bleeding, or hold back. History shows us which choice they made, and the devastating consequences it carried. Now we enter the darkest years of the early Depression, 1930 to 1933. When the Federal Reserve's inaction and the wave of bank failures turned a severe recession into an outright economic collapse. After the crash of 1929, the economy was badly wounded, but it wasn't yet doomed. This was the critical moment when a central bank could have acted decisively as a lender of last resort, stepping in to provide emergency liquidity, calm panic, and keep the banking system afloat. But the Fed, bound by both its gold standard constraints and its own cautious philosophy, largely held back. It didn't flood the system with liquidity. It didn't aggressively support banks under siege. Instead, It watched as the crisis deepened. The result was devastating. Bank runs swept across the country. These weren't just isolated incidents, they came in waves, each one eroding more confidence than the last. Imagine walking into your local bank to withdraw a little cash and finding a line stretching around the block. You know that if the cash runs out before you reach the front, your savings are gone. That fear became self-fulfilling. Even healthy banks, with sound loans and good management, couldn't survive a sudden demand for every dollar in their vault. As banks failed, the money supply contracted sharply. Every time a bank closed, the deposits it held effectively vanished from the economy. Fewer dollars circulating meant less spending, less business activity, and more layoffs. This is how deflation took hold. Prices fell, not because goods were suddenly abundant, but because money itself became scarce. It sounds almost paradoxical. People desperately needed cash, yet the value of cash rose because there was so little of it in motion. And with deflation came crushing unemployment. Businesses, unable to secure credit and facing shrinking sales, laid off workers en masse. By 1933, roughly 1 in 4 Americans who wanted a job couldn't find one. The social and psychological toll was immense. Families lost homes. Farms were foreclosed. Once thriving towns grew quiet, their storefronts boarded up. This wasn't just an economic failure. It was a systemic one. The inability or unwillingness of the central bank to act decisively allowed a financial panic to spiral into a full collapse of confidence. And here's the sobering truth. Confidence is the one resource you cannot print or borrow into existence once it's gone. It must be preserved before it shatters. By early 1933, the situation was untenable. The banking system was in tatters, and public trust was at rock bottom. That set the stage for drastic political and economic interventions in the years to come, interventions that would permanently change the role of the federal government and the central bank in American life. On the next slide, we'll explore those long-term consequences, how the crisis led to a lasting expansion of centralized monetary and political power, and how the incentive structures of the system shifted in ways that still shape our world today. The years after the banking collapse didn't just bring recovery efforts, they brought a fundamental transformation in how money and power operated in the United States. This is the era when the long-term consequences of centralized policy truly took shape. First, the instability of the early Depression became the justification for unprecedented federal action. The argument was simple. The market alone had failed to protect people, so only a more active central government and central bank could restore stability. That idea translated into sweeping changes. The Federal Reserve's role was expanded, not just as a backstop for banks, but as a permanent manager of credit, interest rates, and money supply. Monetary policy moved from being an occasional tool to being a constant presence, guiding, prodding, and sometimes pushing the economy in the direction policymakers thought best. But with this expansion came distorted incentives. Once the central bank assumed responsibility for smoothing out downturns, markets began to expect it. Businesses and investors alike grew more willing to take on risk, believing that if things went badly enough, the Fed would step in. This is the beginning of what some call the moral hazard problem, when safety nets change behavior, encouraging the very risks they are meant to protect against. The political sphere also gained new influence over monetary matters. In theory, the Fed was independent. In practice, it operated within a broader government framework that could lean on it to support policy goals. This deepened the link between politics and credit, a connection that can be used for stability in crises, but can also be abused for short-term gain at the expense of long-term health. And then there's the shift in public expectations. Before the Depression, many Americans didn't expect the federal government to manage the economy directly. After the Depression, that expectation became the norm. Citizens came to see Washington as the ultimate problem solver for unemployment, inflation, banking troubles, you name it. That change in mindset has endured for generations, shaping political debates and economic policies right up to the present day. We also can't ignore the precedent set by these years. Once power over money becomes concentrated, it rarely disperses. Instead, it tends to grow. The mechanisms built in the 1930s, emergency lending, tighter regulation, and centralized control over currency, have remained, often expanding in scope during later crises. So while the New Deal and other reforms aim to stabilize the economy in the short term, they also locked in a model of centralized control that fundamentally altered the relationship between markets, money, and the state. The result was a system more capable of coordinated intervention, but also more vulnerable to the errors, biases, and blind spots of those doing the intervening. On our final slide, we'll pull back and ask the deeper questions. What lessons can we draw from this period? Do these patterns repeat in modern times? And what does history suggest about the balance between stability and freedom in the realm of money? We've followed the story from the Roaring Twenties to the depths of the Great Depression, and now it's time to step back and ask the big questions. the lessons and moral debates that echo far beyond this one era. History teaches us that every economic system operates on trade-offs. Centralized monetary control can provide stability in moments of panic, but it can also create the very conditions that lead to those panics. By setting the tempo of credit and money, policymakers can smooth the ride for a time, yet each intervention risks distorting the signals that markets rely on to allocate resources wisely. When those signals get scrambled, malinvestment follows, and eventually, the bill comes due. This isn't just about numbers on a chart. It's about human behavior. When people believe that a central authority will always step in to rescue the system, they often take greater risks. When credit is easy, businesses expand into ventures they might otherwise reject. When money is tight, those same ventures can collapse in a heartbeat. These cycles raise an uncomfortable question: are we building resilience, or are we quietly building fragility that will reveal itself in the next downturn? The Great Depression also forces us to think about the role of freedom in economic life. In the 1920s, markets were freer but more volatile. After the 1930s, they became more managed but also more dependent on central oversight. Which is better? That depends on your view of whether stability should be engineered from the top down, or allowed to emerge messily, imperfectly, from the bottom up. Philosophers and economists from across history have weighed in. Some argue that without central coordination, economies are like ships without rudders. Others insist that the rudder itself can steer the ship into danger if those holding it misjudge the currents. The Great Depression offers evidence for both sides, and it leaves us with the uneasy truth that no system is immune to error, whether decentralized or centralized. The moral questions are just as pressing today as they were then. How much control over money should rest in the hands of a few? Can we trust those few to resist the temptation to use that power for short-term political gain? And perhaps most importantly, do we, as a society, value the kind of freedom that allows for both great booms and painful busts, or do we prefer the comfort of a managed stability, even if it comes with hidden costs? History doesn't give us easy answers. It gives us patterns, and if we study them closely, we start to see the rhymes: periods of rapid credit expansion, overconfidence, policy tightening, and crisis. The shapes change, but the rhythm stays familiar. So as we close this journey through the monetary and political currents of the 1920s and 30s, remember that these lessons aren't locked in the past. They are alive in every decision about interest rates, every debate over central bank policy, every argument about how much intervention is too much. If you've enjoyed this deep dive into the forces behind one of history's most consequential economic collapses, be sure to like, comment, and subscribe to Truth Behind History. And if you want to dig even deeper into the parts of history that are often overlooked or misunderstood, check out my book, History They Tried to Erase. You'll find the link in the description. And of course, explore more of my videos if you enjoy history told with both thoughtfulness and personality.